This price action shows a significant upward rally that has stalled into a narrow base candle. For many traders, this pause is an inflection point where they are forced to guess whether the trend will continue or reverse. Institutional traders use these tight consolidations for accumulation or distribution. Identifying their specific intent requires analyzing three variables: higher timeframe context, lower timeframe volatility contraction patterns, and the mechanics of imbalance gap fills. Integrating these perspectives shifts a trader's approach from gambling on market noise to identifying probable directional shifts before the next expansion begins. The standard for analyzing a higher timeframe base candle requires that we never evaluate it in isolation. You must look left on your chart to find the historical supply and demand zones that provide the setup with its logic. If a price drop leads into a base candle that sits directly on a historical demand zone, the location is validated. We then zoom into the hourly or 15-minute chart to find an execution trigger, the volatility contraction pattern, or VCP. Contrast that with a base candle forming in a random area without historical support. Without a foundation of buyers on the left, the lower timeframe structure typically breaks down, leading to a drop-base-drop continuation. The market location provides the directional bias. A base candle serves as a predictive signal only when it is anchored to a validated macro supply or demand zone. These two rallies illustrate the difference between sustainable and imbalanced price action. A healthy move shows overlapping wicks representing micro pullbacks. An imbalanced move consists of vertical candles with zero wicks. When price surges without internal pullbacks, it leaves a structural void. Because markets move toward equilibrium, price is frequently drawn back to fill this specific gap in liquidity. This gap fill behavior manifests as recognizable chart structures. At the peak of an imbalanced rally, we look for an M pattern to begin the descent. At the bottom of an imbalanced drop, a W pattern often signals the recovery. Recognizing a wickless imbalance provides a roadmap for where the market is likely to return, turning sudden spikes into tradable M and W structures. Calculating targets for these patterns often involves complex geometric shapes named after animals. Instead, we can use the numerical ratios established by Leonardo Fibonacci to determine exact reversal and extension levels. This W pattern is overlaid with a standard Fibonacci retracement tool. We follow a one-step up rule to find the target. A pullback to the 0.236 level maps to the 0.618 extension, while a hit at the 0.382 level points towards the 0.786. The highest probability reversals occur within the golden zones. For instance, a retracement touching the 0.500 line maps directly to a target extension at the 0.886 level. Here is a drop without wicks that halts at a base candle on a historical demand zone. Price has retraced to the 0.500 Fibonacci level. Based on the rules we've covered, what structural pattern and target extension should we look for? The drop created a wickless imbalance into demand, so we anticipate a W pattern recovery. Since the retracement touched the 0.500 line, the corresponding target is the 0.886 extension. Actionable harmonics are based on a numerical sequence. By applying these progressions, you can identify precise reversal turning points without memorizing complex geometry. This execution workflow has three parts. First, find the base candle and its historical context. Second, spot the wickless imbalance. Third, map the harmonic target using the Fibonacci sequence. It is important to note that trading these harmonic patterns as standalone signals carries a low probability of success. Historical data shows that patterns traded without surrounding context fail 70% of the time, leaving a baseline win rate of only 30%. This low probability is why harmonics must be layered over supply and demand zones and base candle confirmations. These layers act as a filter, removing the false signals that lead to high failure rates. Consistency in trading comes from mechanical, multi-layered logic. If this structured approach helped clarify your analysis, subscribe and leave a comment on the next technical concept we should break down.